This is InvestTalk. Independent thinking, shared success.
Hi there, this is Zach calling from Michigan, giving a call about Southern Company, ticker SO. I currently hold the stock and have for quite some time, and I've done well on it. And I'm just wondering if it's something that you think I should continue to hold for the long term and add to. And if it is something I should continue to add to, does this give me enough diversification as far as the utility sector, or is there other things I should be looking at in that sector as well? Thank you so much. Bye.
Ticker is SO, and the company is Southern Company. Southern Company is a major U.S. utility holding company headquartered in Atlanta, Georgia. About 9 million customers across 6 states, operating in Georgia, Alabama, Mississippi, and a handful of other places. Earnings, not bad at all. Reported on July 31st. Q2 net income was 98 cents, down a bit from a year ago, but not too much. Adjusted earnings also lower, though they did see a 7.9% rise in revenue. Year to date, the stock is up 15.32%, up 4.51% over the past 3 months. And in that time, also outperforming its industry at 2.9%, outperforming by 2.9%. From a valuation perspective, a bit expensive, though you do see that broadly in some of the utility space right now. Utility's doing pretty well, just in general, over the past 52 weeks. Forward-looking price earnings 21.1 times at the high end of that 5-year range. The 5-year high being 22.1, price to book at 3 times. Now, a lot of utilities tend to have a bit of debt. This is a $103 billion market cap company. They have about $66 to $70 billion in debt, depending on what time frame you're looking at. It looks like most recent quarter, about $70 billion in debt. Their interest coverage ratio, 1.98 times. But this leverage is to be expected in the utility space. And much like other utilities, they also pay a decent dividend, set at about 3.1% this year. I would say the average, though, over the past couple of years is closer to about 3.7, 3.8. The lower end right now being because of that massive price appreciation year to date, again, 15.32%. And so what's driving this utility and what's driving utilities in general? One of them is, as interest rates came down a bit, though not much, in the past year, really the end of last year, you saw people reaching for yield in other ways. Another thing that is dragging utilities upward is the demand for energy from data centers, AI-related CapEx spending. And so this company that gets about 73% from its traditional electrical operations has done pretty well in the southern area where there have been a lot of energy-related projects that is. Now, what to really look for here, they have upcoming new projects, particularly in Georgia. Hopefully they seek to increase that dividend yield as revenue did a bit better this year. Their margins also expanding up to 16.7%. Now, you mentioned, do you want to get more diversification within the utility space? And I think that's fine to an extent, but you have to understand that utilities in general are a very small portion of the U.S. market that have been driving outsized returns this year, right? If we just look at the S&P 500, utilities are going to be, this isn't going to do anything for us. Let's go over to SPY here, take a look at the ETF, because sometimes they don't like to give you the index data. But if you take a look at the S&P 500 here, and you scroll all the way down to our sector breakdown here, utilities really not even listed for how little it makes up there. And so I wouldn't want to give too much to utilities. Your main focus from utilities, the main reason why you invest in them is going to be because of the income, not really because of the growth. Really an uncharacteristic year that we've seen over the past year. So if you wanted to diversify out, you have good exposure, you're up a bit, and you want to get more outside of the income types of investments, I think it's perfectly fine to start to diversify elsewhere. That is Southern Company, ticker SO. Alrighty, every day now it seems like we're getting more and more questions over there on the InvestTalk YouTube. And we do love those questions because we do love our viewers as well as our listeners. And if you're over there on our YouTube and you got a question, well, you just leave it over in the comments section. We'll get to those as quickly as we can. This one coming in from Nicholas Collins, 42 260. And it's on ticker BDT. It says, hi, with this recent drop in bird construction, I'm wondering what you think is a good time to buy. Thanks. I will be listening on the podcast. Well, Bird Construction is not a company that focuses on birds. It is a company that focuses on construction. It serves clients in the industrial, mining, institutional, retail, commercial, and multi-tenant residential space, building things. It's had a rough year, about 10% down about 9% over the past 3 months. And it is not a US company. It is headquartered in a city that I would butcher, so I'm not even going to try it, but it is in Ontario, Canada. Now, their Q3 2025 earnings did look pretty okay. I'm sorry, Q2 earnings did look okay. But I think a lot of the struggles that you've seen, even though you did have this negative 2.1% surprise to the downside on earnings and a bit of a miss on revenue, what you're seeing is a delayed tariff effect here, right? Some rising trade tensions between the US and Canada, where this company is, and what that might mean for revenue and profits down the road. Let's take a look at their debt as well, right? Because you have seen this revenue, although it is slowing, it is still climbing. Well, from a debt perspective, not much debt on their balance sheet, only about 213 million Canadian dollars on a 1.2 billion market cap company. But margins are really low, right? Margins are very small in this industry broadly. And so when you have the potential to have rising costs, companies such as this can't really manage it as well because those margins are tight to begin with. And that's why over the past 5 years, it's sitting at about its average in spite of what has the price falling over the past 6 months, 7 months. It's sitting about near its average. So overall, I think it's got a lot of issues thematically. Not really a big positive trend on the chart as well over the past couple months. So I'd still wait to see what the market has in store before I'd consider entering Bird Construction Inc., ticker BDT. Alrighty, let's drop in another listener question now.
Hi, I want to thank first of all to Justin and Luke for the amazing show and all the information you guys are providing. Thank you so much again. What I want to know is, in terms of long-term investment, what kind of financial ratios do you guys or do one should typically look into to understand the company and to decide if this company is a go, no-go kind of a thing? Again, thank you for so much of your information, and I keep hearing the show every day. Thank you guys again. Bye.
Alrighty, so what are some important financial ratios to look at? There's a lot. Right? When you're analyzing a business, there is no one size fits all thing that just tells you, well, this is a good company, this is not a good company. There are so many things to look at. When you're talking about looking at liquidity, current ratio, quick ratio, cash ratio, this is all telling you how much liquid cash or investments a company has relative to what its liabilities are. There's leverage ratios, your debt to equity, all sorts of leverage ratios that can tell you, okay, how do they capitalize this business? Does this company have more debt than other companies in its industry? There's profitability ratios. That's what margins are, your net margin, your EBITDA margin, your operating profit margin relative to your book value of your assets. Then you have your valuation multiples, your forward-looking price to earnings, price to book. You have your efficiency ratios, your asset turnover, your inventory turnover. It becomes incredibly complex and incredibly difficult. And some of these ratios mean more for some companies than they do for others. Inventory turnover is going to mean a lot more for a retail company than it is going to mean for a utility company. And so that's to say, it is difficult when analyzing these companies to just say that there is one size fits all. You have to have a holistic approach. And it's not just about how the company is doing, because most of the return of a stock is going to be how the market returns. After that, a lot of it's going to be how the sector returns. So little is dependent upon what the individual company does. And so when you're looking for these companies to invest in, you have to get the top stuff done first. What is your macro worldview? How does your theme, the theme over which you're investing, how is it informed by that macro worldview? Only then can you start to dive into some of those critical ratios: profitability, cash, leverage, to help you select appropriate companies for your strategy and your risk profile.
This is Dan from Walnut Creek, and I had a question on a stock, A.O. Smith Corporation, stock symbol AOS. I purchased a small lot in November of last year. I was wondering what you think about the future of the stock. Any information would be validly accepted. Thanks very much. Bye.
A.O. Smith Corporation, ticker AOS, is a world leader in water technology. They manufacture residential and commercial gas, electric, heating, and water units. And year to date, they're up about 5.34%, but in spite of that, over the past year, down about 11%. From a valuation perspective, sitting at about their average, though slightly below in terms of forward-looking price to earnings. It's about 17.8 times forward-looking price earnings. Price to book a bit elevated, 5.7 times. That is their exact average over the past 5 years. Now, they have had decent earnings and guidance. They reported adjusted EPS of 1.07 on July 24th. That did exceed the expectations. But if you take a look at the revenue, one of the reasons why they've done so poorly over the past year is because growth has really slowed to the point where from 23 to 24, revenue actually went down. And net income went down as well, from $557 million down to $534 million, as margins stayed about the same, though compressed a little bit. Now, with that being said, right, the industry itself was down by a bit more year to date. They're outperforming their industry still by about 50 basis points. Apologies, the industry is positive, as is the stock year to date. Little misread there. But either way, I think you have kind of a cyclical issue here. Q3 earnings was good, but you see a bit of a change in housing starts. One thing that is perhaps going to inform maybe where the stock goes is something I saw the other day, which is that it is cheaper to buy a new house right now than an existing home. There could be many reasons why. Could be because the cost required to get somebody out of their low mortgage is more expensive than what you can construct a home for right now. But either way, it is likely that the largest contributor to home sales could be from new homes. And if that's the case, well, then a company like A.O. Smith stands really to benefit greatly. That could be one of the reasons why they've had pretty solid earnings the past couple quarters. Things starting to turn around a little bit. Revenue starting to peak up yet again. Either way, it's in a bit of a pullback. Taking a look at its chart, I mean, it's trying to break this downtrend it's had since October. Started on a bit of an uptrend since June. It's sitting at about where it has been over the past 5 years. Wouldn't say it's too expensive or too cheap, but a lot of risk here, given where it predominantly generates its revenue from. But keep in mind, should housing starts and construction start to pick up or continue at the levels they are, well, this name stands to benefit. That is A.O. Smith, ticker AOS. All right, let's get to two in a row and switch back to the comment section over there on our InvestTalk YouTube channel. And this is on ticker WULF, which is TeraWulf. It says, hey guys, Steve from San Francisco. What are your thoughts on WULF, an AI data crypto company? Just struck a deal with Google. Looks like a lot of tailwind for the next 5 years. Well, it has been a rough couple days in the AI space, given what some people are trying to interpret as a rotation out of an area that has had a lot of CapEx spending. Do I believe that necessarily? Maybe, maybe not. I need to see some longer term trends. But you know who has done pretty well? WULF, TeraWulf, up 5.69% just today, up 63.96% year to date, up 136.74% over the past year. But most of that, a lot of that, really after that announcement of that Google partnership. It is a company that, surprise, surprise, does not make money. Early stage company here, even with its massive appreciation. It's at about $5 billion or $4 billion just a year ago, was half that. Revenue, though, picking up quite a bit as well. What do? They own and operate fully integrated, environmentally clean Bitcoin mining facilities in the United States. And so the price of this is probably going to be pretty tied to the price of Bitcoin. I don't know. I feel as though if you're trying to get some exposure to crypto, there are probably cleaner, less risky ways to do it. This is essentially going to be a highly levered bet on Bitcoin. Interestingly enough, it also has a decent tie-in towards nuclear, hydro, and solar energy, because that is what they're producing. And so, I think there are, say, cleaner, ironically. I think there are better ways to get exposure here with a lot less risk, regardless, in spite of the massive price swing year to date. That is TeraWulf, ticker WULF. Alrighty. Keeping with the theme of AI, keeping with the theme of technology, let's talk a little bit about some risks, right? Because there has been a lot of focus on some of the benefits of AI towards industry, towards our everyday lives. But cybersecurity researchers are seeing something that is worrisome. In fact, some recently showed that ChatGPT could be jailbroken to help them write and debug malware in just 6 hours, highlighting a new risk that maybe hasn't been on the forefront. Generative AI has lowered the barriers for hackers, allowing them to operate at scale without the teams of costly infrastructure that they have needed historically. They now LLMs power phishing, spear phishing, social engineering attacks, enable fake emails, deepfakes, and even cloned voices or video calls. There are criminal tools out there that are not expensive, some for as little as $150 a month, and that's giving hackers cheap access to AI-driven fraud capabilities. Malware itself, because of this, is becoming far more adaptive. AI-powered code can request new instructions mid-attack to bypass security systems, as seen in July's Ukraine cyber attacks. Companies have been looking at this as well. IBM found that AI played a role in 1 in 6 data breaches and 2 in 5 phishing scams this year. Deloitte projects that AI-enabled fraud could reach $40 billion by 2027. That is up $12 billion from 2023. That is a significant increase in a very short time span. Cybersecurity spending, therefore, is understandably set to surge by 25% from 2024 to 2026, reaching $240 billion, which could potentially drive sector outperformance in markets. It's also driving a lot of M&A. Palo Alto Networks, SentinelOne, other firms are on an acquisition spree, spending billions and billions of dollars to shore up their business models. And so while competition is strengthening defenses, we have to be cautious about the rush to build ever more powerful AI models, because it means security risks may lag behind innovation, or rather may lead innovation. And what does that do? It keeps lots of businesses struggling to keep up. Certainly AI has a lot of benefits. Certainly these models can help productivity, but you also have to understand the risks of the technologies being created. Alrighty, let's get back to the InvestTalk voice bank and answer this caller question now.
Reaching out to you in regards to FactSet Research Systems. That's ticker symbol F like Frank, D like dog, F. I hold this stock. I have a position in it. I want to know what you thought about this stock. Once again, that's FactSet Research Systems, ticker symbol FDS. Thank you and have a great day.
Taking a look at FactSet Research Systems, that is FDS, and if you are viewing over on our YouTube, that is exactly what I am using right now to take a look at all these companies, analyze news, look at earnings. It is one of the primary tools that I use on a daily basis. Now it's up 3.62% today, but unfortunately still down 20% over the past year. From a revenue perspective, sales have been a bit or have ticked up a bit, though growth has slowed pretty significantly, right? You had about 8.9% growth over the past 5-6 years on an annualized basis, yet still grown from 2.2 billion to 2.3 billion this year. And in the same time, margins have expanded. They hit a high during the pandemic, about 25.1, then dipped down all the way to 21.5 net margin, projected to be about 28.3 this year. It is a leading provider of financial data. They have pretty strong cash flow as well. Free cash flow sitting about 657 million right now. Net operating cash flow sitting about 747 million right now. And its market cap really isn't that big, right? Only $14 billion market cap company. And so there are certainly some risks here, right? It's trading well below its average. I think one of the biggest risks is threat of new entrants here. I would contend that the industry is so used to certain types, or rather certain UI interfaces, or UIs, user interfaces, certain tools, such that inertia is an incredibly powerful thing. But progress in generative AI, in large language models, and aggregation of data has certainly got investors worried that, okay, it is now easier and easier to make technologies that scrape the internet, that get all this data. What value does FactSet really have? And that is really what I think has led to poor performance year to date. It's all about the bottom line, right? You can have revenue grow, but if earnings are missing consensus, not necessarily a good thing. Now, FactSet is a company that we do hold for our clients. We think that FactSet is and has been a leader within financial data. And from what we've seen in terms of their AI integration, certainly planning for a future. And so for me, I use it. I like it. FactSet Research Systems, ticker FDS. All right, let's keep things going. Here comes a question from Massachusetts on 888-99-CHART.
This is Fred giving you a call out of Massachusetts. Wanted to get your opinion on a stock that I bought a few months ago, and it's Casella Waste Systems, ticker CWST. Not sure what to do with this thing. Thank you so much. Take care.
All right, let's pull up Casella Waste Systems. It is headquartered in the beautiful state of Vermont. It's had a rough year, down about 4.45% year to date, down 12.99% over the past 3 months. And what it does, well, exactly what it sounds like it does. It engages in the provision of solid waste management services operating in the eastern, western, mid-Atlantic regions. Most of its revenue coming from its western region, about 38% of this revenue comes from there. But overall, I think from its business segments, pretty well spread out, well diversified. Going back to 2019, relative strength looking pretty darn good in my opinion. But, over the past 3 months, in spite of a Q2 earnings beat, in spite of strong free cash flow growth, you've had a bit of underperformance here. And it's underperformed the industry by about 17.9%. A lot of what they've done has been revenue expansion, not from internalized growth, but through M&A, through price increases. And what that's done is it's seen the stock pull back from a high of about, I'd say about 120 down to about 101 where it sits today. And that's pushed its valuations down to a expensive yet more reasonable level. 18.5 times price to cash flow, 4.1 times price to book, 3.7 times price to sales, 77.1 times forward-looking price to earnings. Their free cash flow is robust. There is no doubt about it. It's a $6 billion company. It's only got $1 billion in debt, and it has been a strong performer for a very, very, very long time. Performed really well during the pandemic. Performed really well in 2019. Only underperformed the S&P 500 with the exception of this year in 2023. But I don't know. This is an example of one of those businesses where I always like to say that sometimes the unsexy businesses are some of the best ones to invest in. But at the same time, 77.1 times forward-looking earnings, 18.5 times price to cash flow. A little bit expensive. So for now, I'm hesitant to want to enter a new position in Casella Waste Systems. That is ticker CWST. Alrighty, unless you have done so already, I want to encourage you to head over to the InvestTalk store at investtalkstore.com, where you can check out our hats, our mugs, our shirts, our polo shirts like the one I'm wearing today, all sorts of products where you can rep the InvestTalk family. This for us is one of the biggest parts of our lives. We do this each and every day, 5 days a week for the most part, except for tomorrow where we're running a replay. And so I don't just wear this on the show, I wear my InvestTalk bucket hat outside. If that sounds interesting to you, or maybe you have a loved one who has a birthday coming up, I encourage you to head over to investtalk.com and check out what we've got. And if you want something different, shoot us an email. We are very flexible and always willing to support the family.
Hi, I'm calling today about Expedia, ticker symbol EXPE. I've held it for less than a year. I'm wondering what you think about the company in this environment right now. Thank you very much. Bye.
Taking a look at Expedia Group. Expedia Group is an online travel company. They are probably more familiar to you as Expedia. I think they own, what else do they own? I'm blanking. Trivago, the Trivago segment as well. I think hotels.com might be Expedia. But essentially it's for travel. It's for vacations. It's for bookings. From a relative performance perspective, been pretty okay, I would guess. Or I would say, rather, over the past couple months. Over the past year, certainly up 54% over the past 52 weeks. But didn't really have much of a strong recovery coming out of the pandemic where the names didn't do too well. From a debt perspective, it's got a bit of debt, about $6 billion in debt on an $80 billion market cap company. But earnings look solid. They raised guidance. They beat on earnings. Revenue looks good. From a technical perspective right now, they look pretty decent. Been on a solid uptrend since April. Huge price climb since the end of July. But you also have to remember where we were a year ago, right? People were thinking, okay, recession is imminent, spending is going to come down. And so when they beat, when consumers end up spending more than would have been thought through their technologies, Travelocity, Vrbo, Hotels.com, Orbitz, all well-known brands, well, then the company's going to do well. 68% of its revenue comes from business to consumer. But the risk here is, okay, it's had a big run. Again, up 26% over the past 3 months. It is still raising guidance. In spite of that, prices could be climbing. Inflation could be ticking up. We're seeing retailers already say the same. And so will consumers pare back spending on travel? That's my hesitancy for this particular name. But it's not that expensive. 13.1 times forward-looking earnings, 9.9 times price to cash flow, 2 times sales. This is a tough one because it is a name that has had solid performance, past performance, and is trading at a reasonable price. But you can't not be cautious given the potential risks of rising prices, of rising costs, and what that would mean for travel. That is Expedia Group, ticker EXPE. Talked a little bit about it, but we're getting some mixed forecasts here from various retailers. Target and Home Depot raising doubts about the strength of the 2025 holiday shopping season. Those two names being two of the ones that are giving conflicting forecasts, right? U.S. import tariffs under President Trump and subdued consumer spending are starting to pressure retailers and raising inflation concerns yet again. Target executives said they are planning cautiously due to uncertainty and volatility in consumer demand. Consumer sentiment is weakened. Shoppers expect slower growth and higher inflation ahead. Two things that you typically don't want to come together. Brands are shifting strategies. Adidas plans higher U.S. prices. Levi Strauss will cut promotions. Under Armour is weighing broad price hikes. And economists note, though, that consumers are still spending, but are a bit more selective, with companies walking back earlier promises to avoid those price hikes. While the S&P 500 is up 8% year-to-date, consumer discretionary stocks have only returned plus 1%, reflecting the market expectation of continued consumer deterioration. TJ Maxx reported a strong second half start, benefiting from those value-oriented shoppers. Another sign that people are trying to save wherever they can. As the holiday season approaches, you cannot ignore the earnings, the guidance, the forward-looking forecasts of these companies, the ones that are on the front lines of retail spending. And certainly that information should help you decide how you want to allocate your portfolios. I'm Luke Guerrero, and this completes another InvestTalk program. Justin and I thank you for joining yet again. And I want to mention that if today's show made you think about your own financial picture, your investments, your taxes, your retirement, am I saving enough for my kid for college? Any of these many questions, we would love to speak with you. At KPP Financial, we offer no-cost portfolio reviews to people just like you each and every day. Just head over to investtalk.com and click on the portfolio review button. And also tell your friends and family about this show, which is available on YouTube, iTunes, and Spotify. I want to remind you once again, tomorrow will be a best of caller questions episode. And we'll be back with you on Friday for another live show. Can't wait to see you till then. Independent thinking, shared success. This is InvestTalk. Good night.